Good morning, viewers, and welcome to the channel. My name is Shannon Rifkin. The date is the 25th of January 2023, and the video this week with big tech companies announcing layoffs. Why are they suddenly rallying after a disastrous 2022? So if you look here at the share prices, and this is on a percentage basis since the beginning of 2022. Obviously, 2022 was a disaster. With many of these names, down 30, 40, 50%, and the one in green, Spotify, down even more, down 70% at one stage. But of course, as we've clicked over into the last part of 2022 and early 23, we've seen at least a bottoming and starting to see a good rally, even as we are coming into this quarterly reporting period where, for the most part, the commentary has been pretty bleak. Almost all of these big tech companies are announcing pretty big layoffs. Somewhere between kind of 5 and 15% of the workforce is being laid off, which reflects obviously a much more difficult economic outlook. And of course, they're seeing that in their underlying businesses, of course, and expecting that to continue as the central bank tightening around the world continues. But they're rallying. So then, of course, the question is why. And the short answer, of course, is that equity markets move first. They are forward-looking, and at any one point, the share price will never reflect what we've seen over the last 6 or 12 months, but rather what is expected over the next 6 and 12 months and beyond. So the simple fact is that this sell-off throughout this period was very much forecasting what was being announced right now. And just on the flip side, of course, the strong performance recently has been possibly on the likelihood that of a hard landing recession, starting to lighten a little bit as some of that inflation data that has come out recently has surprised to the downside, and while central bankers have remained pretty hawkish in their tone. If you look at the underlying performance in bond markets, it's pretty clear that investors just don't buy that rhetoric and are starting to factor in a looser environment for monetary policy, which should ensure that, as I said, the underlying performance of these businesses doesn't suffer as much as what was feared. And to the second part, what does this mean, obviously, for valuations as well as bond yields start to turn? So I've got this chart just shows the performance of the US inflation rate, which, as you can see, is starting to roll over, pretty significantly. We'll see in the next few readings whether this is more than just a change in trend and a new trend. But of course, as well, early signs that we've seen bond yields turning around. Yes, certainly well off their peaks of well above of a little above 4, into the more like 3.5% range. But of course, will we see that head down even further? And I've tried to show in this next chart the correlation, at least, or the negative correlation perhaps, with the 10-year bond yield, which you can see here is just starting to roll off as these names are starting to come up. So that to me is probably the bigger story here. These, for the most part, well, at least the more less mature end is obviously Microsoft, Amazon, Google, big companies generating big cash flows. But the less mature big growth tech names such as Spotify, for example, who their promise is long-term future cash flows as opposed to today's profits. That obviously matters. The 10-year and long-term interest rates matter a lot, of course, as the future value of those cash flows are discounted into today's dollars. A lower long-term interest rate matters. So I think that's probably the biggest story here, and I think therefore how we see the next 6 months will probably be how we see inflation unfold over the next few months will probably play a bigger role rather than necessarily the underlying performance of the businesses themselves. So, it's almost, I kind of used this analogy recently, but it is a mirror image of what we've seen in 2022 so far, and we'll see if that inflation story really unwinds. And my guess is that the mirror image will be almost complete when we look back at 23. in the early part of 2024. So we'll see, but that's what the early data is suggesting. And of course, the caveat, of course, will be if if inflation data starts to show that we haven't peaked and that central banks will need to remain hawkish, and maybe the cycle peak in interest rates still is higher than expected. 2023 could start to look a lot more like 2022, and this recent rally will start to be unwound. Anyway, that's it for this week's video. Thank you for tuning in. If you did like the video, please click like and subscribe, and I will be back with you next week.